So Christine, what are the different types of policies that are being written today?
Okay, there are primarily three types of long-term care insurance policies in the market. There's the traditional long-term care. That's an older product, been around for decades. It's pure insurance, just like car insurance or health insurance. It's there if you need it. You hope you don't, but it's still very valuable to have. Oftentimes, those don't pay a benefit if they're not used. Sometimes you can pay for a return of premium rider. The next product that came along were life insurance products with long-term care or chronic illness riders. That is when you buy the asset, the life insurance. You pay for an additional rider that allows you to trigger that benefit when you meet the definition of long-term care or a chronic illness, and that allows you to liquidate your death benefit in advance to pay for living care expenses. The newer products are called linked benefit hybrids. They're the best of both worlds. You do get a base policy of life insurance so that if you don't use the product, you can receive those funds back in the form of a death benefit. But it also has a pure insurance element, a continuation of benefits rider that can have inflation added to it, and you can create that policy to suit your needs. So you get the best of both worlds, the death benefit if you don't use it, plus the extension of benefits with inflation if you need it for care.
Got it. And what type of care is typically covered within a long-term care insurance policy?
So the technical definition of long-term care is the need for assistance with two activities of daily living or supervision for a cognitive impairment. That is the tax code trigger for anything that's filed as a long-term care product. The ADLs are eating, bathing, dressing, toileting, transferring, continence, or it can be just the cognitive impairment that requires supervision because you are no longer able to function without assistance.
Got it. And does it cover just home care or just assisted? Like what types of care? What's the gamut of it?
So that would cover if you need home health care, if you're in a situation where you may require adult daycare, assisted living, you could be in a continuing care community and you've met that medical trigger. If you have a policy, that would pay benefits, and also skilled nursing.
Got it. And does the policy typically cover more than just care?
Well, if you're having a caregiver come into the home, they're obviously going to help perform some of those instrumental activities of daily living that would require them to help with perhaps groceries, getting to doctor's appointments, transportation, things of that nature. The newer policies that are out there, they do have some pretty nice benefits as far as having a network of care providers and companies that can help facilitate a plan of care. They may even be able to help you find a care coordinator or provide that service so that you can trigger your benefits and then implement the plan of care with the network of resources that they provide.
Got it. So this is a part of the policy that a lot of policyholders don't know about or understand. So I'm going to ask this question.
Sure.
What is an elimination period?
The elimination period is the period of time where you're self-insuring, you're paying out of pocket. Usually with most products, it's 90 days. Oftentimes that 90 days may coordinate with that 100 days of skilled care. If you have a triggering event that would trigger your Medicare benefit for the 100 days, it will line up with that. Some products, if you're doing home health care, can dial it back to a 0-day elimination period.
Got it. So basically the policyholder's on the hook for those number of days, kind of like a deductible for car insurance.
That is correct. And any company that's going to pay a claim, they're going to want to see that that claim is going to last beyond the 90 days because that is the true definition of a long-term care event. 2 of 6 ADLs, cognitive impairment, expected to last beyond 90 days.
So here's another point that comes up specifically with elimination period. Calendar days versus actual days. What's the difference?
So calendar days, if you are in need of care consecutively for that 90 calendar days, even if you don't have a caregiver in the home every day, calendar days are going to be the fastest elimination period. Actual days or service days, it's going to take 90 days of actually having service provided for you to meet that elimination period. So that could take longer.
Right. So it doesn't matter so much if you're in an assisted living facility or skilled nursing facility because you're not hopping in and out. You're there the whole time. It does matter if you have home care and you're not getting home care every day of the week.
That is correct.
Got it. Okay. Can you explain how the benefits work? Sometimes daily, monthly, lifetime. Mm-hmm. How does that work?
So when you're designing a product, often you're going to have a period of usually 2 to 7 years, depending on the insurance carrier. There's a carrier out there that still offers a lifetime benefit on their product. It's pretty rare these days. When you are getting monthly benefits, let's just say your monthly benefit that you're entitled to is $10,000. So you have access to that entire pool no matter what your daily costs of care are. When you have a daily benefit, you're going to be capped. So if your daily benefit's $500 a day, the day that you don't need care, you don't get the $500. The day that you do need care, maybe it's only $300, they'll reimburse that. One day you might need $700 of care. You're capped at the $500. Still not a bad policy to have, but there are limitations on how the daily benefits are paid.
Got it. And as far as lifetime benefit, how does that work?
So if you have a policy with a lifetime benefit, there are some older contracts out there that do have them. Not many of the newer companies offer them, but again, I mentioned there's one that does. That means as long as you are alive and in need of care and you are qualified annually to receive those benefits, they have to continue to pay.
Got it. Until that lifetime benefit is used up.
Until you pass away or are off claim and in no longer need of care.
Got it. Got it. This is another thing that comes up a lot.
Yes.
What is an inflation rider?
That is something you probably should add to your policy if you are in your 40s, 50s, even early 60s. The most popular inflation riders are 3% compound, 5% compound. There are some products that may offer market-driven or index-driven inflation. But the cost of care is going to rise as we get older, especially if you're 20, 30 years away from needing care. So it's important to add that to your policy.
Got it. Because typically someone's going to buy a policy in their 40s, 50s, 60s.
Yes.
And they won't need it till they're 70, 80, 90. So you have this gap
Yes.
of 20 to 30 years. And we all know that the cost of healthcare goes up a lot every year.
Yes, it does.
So by the time you actually need it, it's going to be a lot more than what you think it is today. So another thing that I wanted to ask you is it really that easy to just turn an insurance policy on? How do you actually qualify to activate the policy?
I mentioned there's a tax code trigger for everything that's considered long-term care. Even with chronic illness riders on insurance, their qualifications are similar. You have a need for assistance with 2 of 6 activities of daily living or a cognitive impairment, and the need for care is expected to last beyond 90 days. At that point, you're going to need somebody who's a licensed clinical social worker or medical professional that can prescribe a plan of care and provide any necessary documentation, whether it's test results or physician's notes, doctor's records, to facilitate that claim so that you trigger your benefits.
Right. So just because you're 85 years old, you can't trigger it.
Correct. Or mom's a little forgetful. She got lost on the way home. No, you're going to have substantiary medical evidence so that you can prove to the insurance company that you are in need of those benefits.
Right. So for a physical impairment, it's probably pretty obvious, right?
Yeah.
2 of the 6 ADLs.
Yes.
Cognitive impairment, you're actually going to need a doctor's diagnosis, a physician's diagnosis that you have Alzheimer's or dementia.
Correct. So you're going to there's some cognitive tests that can be performed, and probably a neurologist is going to be involved as well, and some testing will take place. And also you're going to have some input from your primary care physician too.
Got it. Well, I don't have anything else. Do you have anything else for me?
I do. One thing I failed to mention when we were talking about insurance products, there are some other great alternatives out there. We have a growing market for short-term care insurance options. That can be for older clients or clients who may not be able to qualify for the long-term care insurance products that are out there. There are some interesting annuity products as well. There are a handful of carriers out there that offer products that will give you some leverage if you need care by having it in an annuity wrapper. Oftentimes we can take old annuities and put them in these newer products and possibly mitigate any tax liability there could be when you start to spend that money. If you spend it on long-term care, oftentimes those dollars can be tax-free. There are nice death benefits available to your beneficiaries if you don't use them, like with the newer insurance products. The annuity products can be a little bit easier for people to get if underwriting's a little more of a struggle when you're trying to buy those 3 typical insurance products that we discussed earlier.
So it's not necessarily a long-term care insurance policy. It's more of a planning policy. You can use it for long-term care insurance. You can use it for other things.
Yes.
Got it. Okay.
And a lot of times, as I mentioned, we can get creative and work inside of a person's portfolio and just reposition some assets so that we're able to create that income stream to offset the cost of care without disrupting their retirement lifestyle. Because I think that's what people find so scary when they look at an illustration and think, wow, that's a lot of money. What if I don't need it? Well, now we have ways to take care of that so there's no loss of the dollars and can potentially put them in a better tax situation by having a plan.
Yeah, I think that's the biggest reason people don't buy the traditional long-term care insurance today is because people, in their minds, they all think, well, I don't think I'm going to need it. I'm just going to die.
Yeah. Or sometimes the advisor will say, hey, we can just do better than this. Let's keep your money in the market. When my mom fell, I thought I had another 10 years before she became a fall risk based on our family experience. And that wasn't the case. And now we feel comfortable knowing that we've got the plan in place to keep my mom safe at home, and there's money to do it without disrupting her retirement assets.
I think the other thing that people don't really think about is, yeah, you might have the money, but do you have it sitting in cash, right?
Right.
And so what people also don't really realize is it's expensive, right?
Yeah.
It can, literally be a lot of money coming out of your bank account every month, continuously. And so the tax implications of, hey, I got to start liquidating assets, right?
Yeah.
I've been sitting on these, stocks for years, and now I have to start selling them. I've got tax issues that I have to deal with. That's another thing that people don't necessarily think about. They think, oh, I have the money, but do you have the cash sitting there to actually pay for this every month?
Right. And, you can leverage up that cash by simply repositioning it into a product that's going to give you a bigger payout when you have a long-term care event that triggers it. And you can also look at some great tools out there where you can project what the cost of care is going to look like in your region. It's going to be different in every part of the country. Here in New York, it's very expensive. One of the most expensive places to receive care. And you look at those other high cost of living markets where the cost of labor is expensive because long-term care is a labor cost. Okay?
100% labor.
It is. It is.
100% labor.
It's a labor of love, but it's not free if you're paying a caregiver. So it does make sense to say, hey, how can I reposition these assets in a way that makes sense to where we're taking the heat off the portfolio? You look at times when the market was down, most recently 2008, 2020 during COVID. Even now, while we're experiencing some turbulence in the Middle East, the market's down. If you have to take money out when the market's down, or you do have a highly concentrated stock position or other assets where there might be tax consequences, or perhaps I see a lot of people in this region that are wealthy, but they are not liquid. Okay, so if they've got a lot of money in businesses and real estate, things of that nature that are not easily liquidated when the time comes to pay for care, and oftentimes it's a surprise. You don't get to pick the day that it happens.
No, you don't.
Like I said, 11th hour crisis in many, many cases. It's nice to know that you've protected the portfolio, you put a hedge against it by having a separate stream of income available to you to offset the expense. And I cannot tell you how much easier it makes the whole experience for the person who needs care and then the family members that have to be involved in putting the plan in place.
No, you mentioned a good point, because I do have a client who has property, right?
Yes.
But he says, look, I'm on a limited cash income.
Yeah.
And it can be challenging at
Yes.
times. And the other point you brought up, which I thought was really interesting, is that you don't get to pick the time,
No.
right? And so you could have very volatile markets, and the nice thing about having insurance is it's a kind of immune to that, right? Whether
Yes.
the market's up or down, you're kind of guaranteed a stream of income regardless.
That is true. And most of the products are fixed that are out there. I mentioned there are some that have a little upside in the market, but they do have some baseline guarantees with them so that your benefits will lock in at a certain point. So that at least you can count on that in the future, knowing that this is going to be here to get the job done for me should I ever need the money to pay for care.
Got it. Any other topics you want to cover?
No, I think we've covered quite a bit today, actually.
Okay.
Yeah.
Well, look, I'd like to really thank you for coming. This has been really a pleasure.
Yeah.
We're so grateful to all of you who are watching, sending out positive vibes. Thank you so much.